Douglas, you're an investment specialist with Platinum Asset Management. One of the things that concerns many of our investors is that human actors will become less relevant in investment markets. And in fact, people that have the fastest computers, that can run algorithms better, that have pipes that connect into the exchange better than others will be the ones who make money. What's your view on that?
We think probably if that is the case, if we're in a world driven by computers, there'll be even more opportunities for human beings that can think further into the future than the market. So the market operates on probably a 6 to 18 month time frame. It oscillates around. We try and look beyond that, 3 to 5 years out. We try to observe genuine change that's taking place, and that leads to genuine opportunity. Over time, we in our international fund, we've done about 6 or 7% per annum above the index. We've got a Japanese fund that's done 13% more than its index.
Hasn't the index been pretty woeful though?
It's been 2 a year. We've done 15. So you can make money, and we think in any environment. The point I'm making is an active manager over the long term, we think can, if set up correctly, make a lot of money. The problem is most active managers aren't very good at what they do. That's probably one of the bigger problems.
And I think that's what I would point out is that the statistics are that most active managers after fees don't do better than the index.
And most golfers don't break par when they play a round of golf, and most football teams can't compete with Manchester United and so on and so forth. So there are people who are very good at active management, and there are lots of people trying to sell you products that aren't very good, and the index managers exploit that. So they point to the Sunday golfer and compare him with Tiger Woods, and that's the problem that we have. Look, the way we look at things, there are a lot of flaws in indices. What indexes do is they ascribe more value to or greater proportions to companies with higher value. They pay more, or they allocate more to expensive opportunities. So the index is not buying low and selling high. The index is buying high and selling low, and that in itself is flawed. Secondly, when you look at the global index, the US makes up over 50% of global indices. It only makes up 36% of the opportunity set.
How do you define opportunity set? What does that mean?
So we look at all the companies in the world and we say, how much are all these companies worth? What the indexes do is say, how accessible are these companies to the largest fund managers in the world? And so they exclude certain markets where you have to go to a greater effort to invest.
Like what sort of markets?
So China, for example, China's about 14% of the world's opportunity, yet it's represented at 2 in the index because it's hard work for fund managers to apply for a license, which we've done, even as a small player in Australia. It's hard work to research companies where you might not understand the culture or the language. We've been going there for over 20 years. And therefore, it's convenient to exclude it. So I think you've got to be very careful when you look at the index. Are you really buying a reflection of the economy or the market? Here in Australia, people have, I think 30% of the index is in 4 banks. Now, a rational person building a portfolio would not put 30% in 4 companies that look the same and they're all exposed to the same vagaries of the economy, if you like. So we just think that you've got to be very, very careful. So if you can take a very different view from everyone else and be there ahead of the crowd, when the crowd moves, you're likely to capture some value from that.
So we shouldn't be worried about the milliseconds that a high frequency trader is getting an advantage, because there's people like yourself and your team who are making decisions with creative forethought about what the future might look like.
I think so. You've got to work out what are the high frequency traders trying to do. They're really just trying to take advantage of flows of money. They're not trying to make any assertions as to whether a company is good or bad. They're just going in and out and in and out and in and out. And maybe there are some high frequency traders, like there are active managers, who are very good at it. But I would think, if you stop and work out what these guys are doing, it's quite hard to get your head around. It's quite hard to see how they add value over time. So we prefer to stand back and say, this is a good company. We look at Tencent in China or Samsung in Korea, whatever. This company is undervalued by the market. Let's buy it, let's hold it, and let's make a return from that. So that's our preferred approach to markets.
So it sounds like there's still jobs for human beings and that there's still returns for investors.
Well, the panacea would be there were no jobs for human beings. We all lay on the beach every day, but I think we like to think there's jobs for us.
Good. All right. Thanks for spending some time with us.
Great. Thank you.